Hi everyone, Billy here, co-founder of Trade Prosper, and welcome to Section 10, Video 1. In this video, we're going to obtain the answers to the question, why options? Now, I want to remind you of the fact that this particular options course is a little bit different to what you usually would expect to see. And that in this course, we'll basically use options as instruments to improve or complement the other trend trading strategies that Mike has already showed you up until this point. You'll also recall from my previous video that I explained that this course in particular will only focus on the two motives, or two out of the three motives that we generally use for trading options, and that we'll leave the Greeks for another course. So in this particular course, we'll look to cover how do we use option strategies to avoid being stopped out too soon, and then in particular, how also do we use them to express a view. There is one important aspect I wish to highlight. Mike mentioned it as well, but it's worth repeating. When trading, you have to understand that losing is part of winning. So we have to be prepared to lose, and you will have losses. The trick, as we showed you, is to manage these losses. In other words, to have a very, very solid foundation built on very strong risk management principles. And then whenever you have trades that do end up winning, to allow them as much room possible so that they can actually end up generating enough money so that collectively your portfolio still increase in value. So we'll always aim to maintain a positive risk reward number. So a quick and simple example of this is, let's say you're correct only 30% of the time, right? So you're trading, and out of every 10 trades, we'll expect you to lose 7 of the trades. So with proper risk management, let's say you lose $10 every time you lose a trade. And on the ones that you win, you're going to win $30. Now you can see if you have 7 trades losing $10, it loses $70. But the 3 trades making $30 profit makes a profit of $90. So collectively, your account will be up by $20. That's pretty easy to understand, right? And it makes quite logical sense. And that's basically what's meant by having the ability, or providing your winners with the ability to run a little bit to make as much money as they can so that they can pay for your losers. Now, I used a very, very low success rate of only being right 30% of the time. Chances are you'll probably be right somewhere between 30 and 50% of the time, and even more. I mean, as you become more efficient, those numbers will improve or should improve. But I just wanted to show you the example because I've got another hidden statistic that lies in there that I want to talk about. And that is that in order for this statistic to work, in other words, for you to be able to make consistent money over a long enough period, because remember, we're not trading here for a quick win. We're actually trading as a long-term strategy here. And that requires you to stick to your guns for a little while. Now, in order for you to have that statistic to say, well, whenever I lose money, I'm going to have stop losses protecting the loss or the quantum or the size of that loss. But whenever I have a profit, I'm going to let it run so that we make some good money. The statistic that is often overlooked in there is that you can only have that stats work for you if you trade frequently enough. So you can't expect to trade once or twice and expect to hit a winner every time you trade. So using our previous example, what if out of those 10 trades, and remember you were going to have 3 trades right if you traded all of the 10 of them, but what if the 2 times you wanted to trade or the 3 times you wanted to trade, you traded on one of the days where the trade didn't go in your favor? You can see how easily that would be for you to completely wipe out your account, completely. So trading implies taking numerous positions across various securities and markets and managing the risk then with the stop losses that we put in. And we want to create the edges so that we ensure that when you do have those winners, that they actually have a really good chance of making decent profit for you. You can also see, though, that starting off with quite a small trading account also brings with it the problem that how do you trade 10 times if you can't afford to trade 10 times? In other words, if you don't have enough money to actually buy enough shares or sell enough contracts, whatever the case may be, to be part of these 10 trades that you're supposed to take. So hopefully what I'm going to try and show you in this particular video is kind of like a bird's eye view. I'm going to quickly show you just very, very briefly how we can use actual option strategies to just overcome some of these dilemmas that we spoke about now. So to give you the ability to trade a little bit more frequently, even if you have small accounts to start off with. So before going into the details of the actual options themselves or a specific strategy, I thought to put this section together first, just to give you a general overview of two main concepts, like almost overarching concepts, that we'll always keep in mind whenever we trade options or whenever we use options during these trend trading techniques. The first problem is that we want to avoid being stopped out too soon in the position. And the second problem we're going to be addressing is that issue of allocating capital. So as I showed you in the previous example, we want to be able to trade 10 times. So how do we allocate the little capital that we have so that we can access 10 trades, for an example? So I'll show you both of those examples in this session quickly. Okay, so let's begin. I want to show you how often the trading techniques we use also inherently limits the extent to which we can use them. And I want to show you how using options can overcome some of these inherent limitations. So I want to cast your mind back to a section covered by Mike, where he showed you how when trading stocks using a 55-day breakout technique, the stop loss that we initially set on that transaction is going to be the 20-day line that we will use for that. So here's the part that I'm referring to.
Okay, what I have here is an example of a stock, Barrick Gold Corp, ticker ABX. And what you'll see here is we have a sideways setup, 1, 2, 3, 4, 5. On this fifth day, you can see below that the ADX is blue and rising. So we place an order to sell on that day with the cushion. And the next day, we get short ticker ABX on a 55-day low channel breakout. Remember, for stocks and ETFs, your stop is the 20-day high. So your stop is all the way up here.
All right, so from this section, we noted the following entry levels. The order entry was at the break of the 55-day low, which we said was 30.14. And for that entry level, the stop that we will be using was the 20-day high, which in this example was 33.36. Now from here, there's two observations that one can make at this stage. The first observation is that we're talking about a $30 stock here, so it's quite expensive to trade in these shares, and especially if you don't have a lot of capital. Remember, we'll be spreading our capital across numerous trades, so we don't want to put all of our eggs in one basket. So you don't want to attach one specific share and use all your capital just to trade that one share, because then again, that stats that I spoke about in the beginning just won't work. So the aim here is to try and trade these shares without tying up too much of our capital, and that basically is the hurdle that we need to overcome in the first instance. The second observation is that the stop loss is quite far away. Now remember, we were speaking about using a 1% risk of capital rule. And Mike pointed out that with stocks, with them being so volatile, we can't really afford to have the stop loss so close that we run the risk of the position being triggered unnecessarily. This poses a bit of a problem to us, because think about this now. 1% risk of our capital and the stop loss being that far away means that when the stop triggers, it's going to be a fairly sizable stop. So in keeping it in line with the 1%, we probably won't be able to trade that many shares. So let's have a look actually how much we can afford. So we'll punch the numbers into our risk calculator. At this point, I want to remind you quickly, you'll have access to this very same risk calculator in the supplemental section. And remember Mike spoke about the cushion, right? So in other words, the amount that we'll add or subtract to the entry and exit levels whenever we transact in shares or commodities or whatever the case may be. I just want to remind you that the risk calculator that we'll use already takes that into account. So when I put in the numbers of our entry and our exit level, when it calculates the position size, it would have already assumed this position cushion that's taken into account. So it'll throw out quite a conservative number to that extent. Okay, so let's have a look. So we want to go short the share, and with the entry level, let's put that in as 30.14, and the stop at 33.36. You'll note that the system then kicks out a position size of 29 shares only. So what this means is that should we enter here and we get stopped out, the loss on the 29 shares will not be greater than our risk parameter. So in this example, our risk parameter was 1% of our portfolio value, and the portfolio value here was set as $10,000. But what if we change this portfolio value? What if you don't have $10,000? Let's say we change it to $5,000. Note now how this drops the number of shares that we can trade down to only 14 shares. And what if you have less? Let's say you're a beginner that starts out and your account is worth, let's say, $2,000. Using a 1% rule, the amount of shares that we can trade drops to five shares only. Now, it's important to understand here the overarching rules of the system or the trend trading techniques will override any of our own motives. So what I mean by that is, yeah, trading 5 shares is hardly exciting. I'll give you that. But the point is, we unfortunately have to stick to this rule. We have little choice. The key of trading is to manage the risk, not to try and swing for the fences and make money on a one-off trade. Like I mentioned earlier, we want to make sure that we approach trading from the right angle, and this is a long-term business and it's a very, very sizable wealth building engine, but we have to be able to stay in the game in order to get this process to work over time. There's no point in hitting a big number too soon and we risk too much and all our capital is depleted, and then we can't get back into the game again. So even if it's 5 shares, that is what we will trade. No debates, no discussion, that's it. However, I want to quick show you something. Note that when I said our account size was $10,000, right? Our maximum risk is $100. And even at that point, given this Barrick Gold shares, we could only trade 29 shares. Because 29 shares eats up the risk. In other words, we don't want to lose more than $100 if we get stopped out. But just make a mental note of the following situation. When we trade options, each options contract trades in multiples of 100 shares. In other words, by buying or selling one options contract, we effectively control 100 shares. That's quite a bit more than the 29 that I just spoke about. So using our risk calculator, let's quickly see how many shares, or rather how big should our account be to control 100 shares. And I'm guessing it's going to be around $40,000. No, wait, a little less, $35,000. There we go. Okay. So with that, we need $35,000 at a risk parameter of 1% to be able to control 100 shares, where on the other example, buying one options contract also controls 100 shares. So just keep that in the back of your head for now, how big this gap is between how much is needed to buy an option for $100, or rather for 100 shares, against this $35,000 you need given our risk parameter and these stop loss levels to control 100 shares. All right, so now I've shown you how the size of your account plays a role. I want us now to look at the second part of the equation. Now remember, we spoke about how stocks being so volatile, the worst thing that really can happen is you've done all your homework, the trend is going to happen, you're in the trade, but because of the risk management that we have to adhere to, you get stopped out unnecessarily, or rather the market itself momentarily spikes up, triggers your stock or your stop loss, cuts you out of your position, and then from there it goes lower. So a quick way to overcome this is to buy a put option, for example, in this particular example. Now, at this stage, you don't know what a put option is yet, so I'm not going to spend a lot of time on it. But just for now, recognize that a put option allows you to sell these shares. And remember, in this particular trade, the trend was downward. So our entry trade here was to sell the shares. So it kind of mimics the same type of share. Sorry, it kind of mimics the same type of direction. We want to be short the share. So in this example, if we take an option, let's say for 1 month or even 2 months or so, it buys us the time to see what happens without ever having to worry about what's going to happen with the stop loss. As the examples become clearer, you'll understand the function of premium, and that is the maximum risk that you will ever face, only if you buy options, of course. But the point being is, once you've spent the premium, you've crystallized the maximum loss. You will never, ever, ever lose less than or more than the premium. So in this example, once we've paid the premium, we've actually now given ourselves time and a convenience factor that we don't have to care so much about what the spot's going to do on the way lower. So if it spikes up, we don't really care. I mean, for a bought option, we have all the time until the option expires to see what happens. So on this day, when even though if we had the original stop loss in place, we would have been triggered out, this option will keep us in the position so that when we get to this point, we'll be short the shares at our original strike level back up there. All right, so I know your immediate question is, how much premium is it going to be exactly? Now, the example we used in this case is Barrick Gold, and rather than trying to scroll back in time to match the option prices exactly to this scenario, to see how it would have worked, I just took a current scenario and I looked for a share that's kind of in the same price range. So I found Morgan Stanley, currently trading at around $37.50. And we'll use that as an example just to see how much options cost. So let's pretend we've done all our homework. It's a sideways setup has happened here. We want to go short this share from here. And it's a $37 share. How much is it going to cost us to enter into an option? So you can look here. This is the option price chain for Morgan Stanley. And I'm just going to look at let's say a month from now, which will give us enough time to see if this trend unfolds. And you'll see here that I can buy a $38 put for a premium of $1.33. Now remember, options trading in 100 shares per contract. That'll mean I have to take the $1.33 times 100 shares, makes this option worth $133. If that's a little bit too expensive, I can also look at the $37 put, because remember, I just want to be short this share. So if I'm short at 38 or short at 37 and the trend is much, much lower, I still achieve the outcome that I'm looking for. So a $37 put costs $85, so 85 cents times 100 shares. Now the point is, I wanted to show you that the pricing is not that expensive at all. So with this $133 or the $85, whichever one you chose, you controlled the price movement of 100 shares. Now, if you recall from the earlier example where we said one of the constraints on small accounts is that you can't really access a lot of shares because you run out of money. So if we were to trade 100 shares outright of Morgan Stanley, we would probably need, let's call it $3,700, $3,700 just to trade the underlying shares outright. Instead of having $3,700, if we only have $133, we also can trade 100 shares worth of Morgan Stanley. So we can control the same amount of shares with a fraction of the amount of capital, which is one of the points we were going to address. I know you're also going to ask that 1% risk rule that we're going to impose also doesn't allow us to transact on $133, because I mean, if you have a smaller account, you cannot afford that even. Now, again, don't stress. I'll go into each one of these in great detail in the videos that follow. So don't stress too much about this now. I just wanted to give you the overarching concepts that we're talking about now. So for now, I also just want to leave you with this one last point. Remember in the case where we spoke about the options, we were speaking about 100 shares that we control, not 29, not 14, or not even 5. So there's a lot you need to consider here when looking at options versus just the underlying. There isn't just one rule that fits all. And we have to balance the balancing act between risk and reward very, very carefully. And again, I'll show you all of that in the videos that follow. But having said that, we definitely will not look to use options all of the time. And the strategies we choose will be in line with our view and the constraints we face at that point in time when we're entering these trades. And in some cases, we'll cheapen the premium, even make it zero premium if it has to be. But in other cases, we won't. We will just want to let the profit run and give the position as much potential to do so. So there's a ton to learn. There's a ton still that you don't understand. And just a reminder, at this point, you don't have to understand it. It was just a very, very quick bird's eye view of the concepts that we are addressing. And the reason I'm pointing them out here is just to underscore once again, this is not the typical options course. We are speaking about fundamental concepts here that are not really tied to trading an option in the traditional sense of the word. Okay? So the next 4 videos that will follow will be a bit basic, especially if you already know a little bit about options. But we need to make sure that everybody gets on the same basic understanding level of options. So in the next section, I'll cover an intro about options, just what it is, what is a call, what is a put, and the moneyness of the option. So if you feel that you know those concepts already, I'm happy to say you can skip ahead to section 11, where we'll start looking at some real strategies. But for everybody else, please continue to the next section and take your time in understanding those basic option intros. All right, speak to you in the next video. Thank you.